This stock analysis will be a head-to-head battle between two competitors in the insulin and diabetes business. On the left side, we have the US-listed pharmaceutical company Eli Lilly, and on the right side, we have the dual-listed Danish pharmaceutical company Novo Nordisk. Both companies produce drugs for treatment of diabetes and both have candidates for treatment of obesity. So in order to determine which company that comes out on top and represents the most attractive buying opportunity, we will analyze these companies using this automated analytical tool that contains 5 different intrinsic valuation models. It contains Graham's valuation, Peter Lynn's dividend adjusted fair value, the comparable company analysis, the dividend discount model, and finally also the discounted cash flow model. The stock screener and intrinsic valuation tool used in this analysis is available at my Patreon page, and you can find the link to that page in the description below. To start our stock analysis, we will write in the ticker symbols for Novo Nordisk and Eli Lilly, and the spreadsheet will then load in the data. As Novo Nordisk is traded on the Danish Stock Exchange, we will use that ticker symbol. And when we do that, we will get the performance data, the current stock price, and some of the stock metrics, but not all of them. And as Eli Lilly is traded in US dollars, it will be easier if we can also get this currency for Novo Nordisk. And luckily, Novo Nordisk is also traded on the US Stock Exchange. So let's write in that ticker symbol instead. If we start by looking at the two stocks' performance, we can see that Novo Nordisk is currently down 10% year to date, while Eli Lilly on the other hand is up almost 20%. And if we look at the 1-year performance, Eli Lilly has gained 43%, while Novo Nordisk is up close to 5%. But let's try to go further back in time and analyze the last 1000 days performance for these two stocks. So when we do that, we can see that since the corona crisis, both stocks has performed quite well and increased quite a lot in stock price. If we compare the price to earnings and price to sales for the two companies, we can see that none of them are really cheap at the moment. But Eli Lilly is the more expensive stock with a price to earnings of 52 and a price to sales close to 11. Looking at the analyst 12 months target price, we can see that Eli Lilly has almost reached that price already, while Novo Nordisk, with its current price of $100, still have a 27% difference. By looking at the beta values for the two stocks, we can see that both stocks are normally less volatile than the general stock market. And both stocks currently have a quite low dividend yield of 1 to 1.5%. By just looking at these metrics, I'm inclined to favor Novo Nordisk, but let's take a closer look at the intrinsic valuation of these two stocks. But before we go to the intrinsic analysis, just a short disclaimer. I'm not a financial advisor, and the following content is only for educational purposes and should not be considered as financial advice. The first intrinsic valuation model is a revised version of Graham's valuation, and here we find the stock's fair value by taking the earnings per share multiplied by 7, which is the PE for company with no growth, and to that we add 1 times G, where G is the growth rate projection of the company. And then we multiply by 4.4, which is the average yield of a AAA corp bond, and divided by the current yield of a AAA corp bond. And I've done some research and found a growth rate projection of 13 for Novo Nordisk. So when we put the numbers into this equation, we get an intrinsic value close to $53. For Eli Lilly, I found a growth rate projection close to 20. So by putting this number into the equation, we get an intrinsic value close to $153. And if we compare these intrinsic values to the two stock prices, we can see that both are almost 50% lower than the current stock price for their respective stocks. Our next intrinsic valuation model is Peter Lynn's dividend adjusted fair value. And here we find Peter Lynn's fair value by taking the earnings growth rate, add the dividend yield, and divide by the price to earnings. So when we add these numbers for both Novo Nordisk and Eli Lilly, we get a Peter Lynn's fair value of 0.38 for both companies. By comparing these numbers to the table up here, we can see that as both of them are below 1, both stocks are overvalued according to Peter Lynch. By rewriting this equation, it is possible to find the fair stock price for these two stocks. And when we do that, we get a fair stock price of $38 for Novo Nordisk and $125 for Eli Lilly. And both of these are almost 60% under the current stock price for both companies. In the comparable company analysis, also called the multiples valuation model, we take companies that are similar to Novo Nordisk and Eli Lilly, and then we find the PE values of these companies, find the average PE value, which is then multiplied by the earnings per share for Novo Nordisk and Eli Lilly. When we perform this analysis for Novo Nordisk, we get an intrinsic value close to 70, which is 30% below the current stock price. And when we do this for Eli Lilly, we get an intrinsic value of 127, which is 61% below the current stock price. And this intrinsic valuation also shows that both stocks are overvalued, with Eli Lilly being the more expensive stock of the two. The next intrinsic valuation model is a dividend discount model, and here we find the fair value by taking the next year's expected dividend and divide it by the discount rate minus the growth rate. And here I've added the yearly dividends of Novo and the quarterly dividends of Lilly for the last 6 years. And if we take a closer look at Novo's growth rates, we can see that 2 years ago the dividends decreased almost 60%, and then the year after increased 190%. And that gives us an average growth rate of almost 30%, which is not sustainable going into the future. Based on these data, I cannot even make an educated guess on the dividend growth rate for the next years, and therefore I will choose to exclude this model for our final evaluation. In the comparable company analysis, also called the multiples valuation model, we take companies that are similar to Novo Nordisk and Eli Lilly, and then we find the PE values of these companies, find the average PE value, which is then multiplied by the earnings per share for Novo Nordisk and Eli Lilly. When we perform this analysis for Novo Nordisk, we get an intrinsic value close to 77, which is 22.8% under the current stock price. And when we do the same for Eli Lilly, we get an intrinsic value of 144, which is 55% below the current stock price. And this intrinsic valuation also shows that both stocks are overvalued, with Eli Lilly being the more expensive stock of the two. Our final intrinsic valuation model is the discounted cash flow model, and here I've added the free cash flows for both companies from 2011 up to 2021. The spreadsheet will then calculate the growth rate between each year, and that allows us to calculate the average growth rate. I have then added a discount rate of 5.5% for both companies and a perpetual growth rate of 2%. And that is used to calculate the sum of the future free cash flows. And to that we add the cash and cash equivalents and subtract the company's debt, which gives us the equity value of the company. And when we divide that by the shares outstanding, we will get the company's intrinsic value. So I've done this for both Novo and Eli Lilly. And if we scroll down to the bottom, we will have the results. And for Novo, this comes to $164, which is above the current stock price of $100, and the difference is actually 62%. So when we add our margin of safety of 25%, we still have an acceptable buy price of $122. For Eli Lilly, we get a discounted cash flow fair price of $283, which is actually 13% under the current stock price. So therefore we'll get a sell signal for this stock even before we apply our margin of safety. So when we compare Eli Lilly and Novo Nordisk with the discounted cash flow model, Novo Nordisk seems to be the better buyer of the two stocks. On the final page we have a summary over the calculated intrinsic values using these 5 models. And for each of them we also have the acceptable buy price and the option to put in a margin of safety, which I've here set to 25%. I have then excluded the dividend discount model from the average intrinsic value calculation. And when we do that for Novo Nordisk, we get an average intrinsic value of $83.47, which is 16.5% under the current stock price. And when we do the same for Eli Lilly, we get an average intrinsic value of $177.98, which is 45.16% under the current stock price. So none of these companies seems to be a great buying opportunity at the moment, but if we should choose a winner, I will choose Novo Nordisk, as this company seems to be the least overvalued stock of the two. However, I think some of the other stocks we have analyzed so far on this channel represents better buying opportunities than these two pharmaceutical companies. If you like this stock battle, please consider to punch the like and subscribe button in order to see more content like this in the future. And take care and have a great week.